which is of course also a very important topic. And what we do is that we split this general theme into 27, and I say in a minute why 27, 27 subtopics. Therefore, each student has his or her own topic, and at the end we publish that in a book, the master thesis also. But on the other hand, those topics are very closely related, which gives the students, of course, the opportunity to interact a lot and exchange their ideas, because there is always one umbrella, there is one general theme. 27 has turned out to be our magic number over the years, but it's not a coincidence or not completely arbitrary, because we found out that this is the right number of students which could work together. So we don't want the group to be too big, so that there is room for interaction. So therefore in the full-time program we have 27 students, and in the part-time program we accept 20 students as well. So far we are lucky in having a lot of applications. So for this program, which started just a few weeks ago at the beginning of September, we had more than 100 applicants. So we really could select the best 27 students. So therefore this is also a guarantee for quality at the end of the day. And I'm lucky and proud to say that always over the years, and I'm saying that not only in India, I'm saying that everywhere, that among the best students have always been the Indian students. They have been talented, gifted, very committed. So I'm really happy about that. Besides the LLM program, we also offer a doctoral program. It's a 3 years presence program, PhD program in international business taxation, interdisciplinary program. So we have also business people on board, economists on board, even psychologists. Tax psychology is also part of the program, but of course, which is also very important. But of course, tax law is at the core of that program, and those collegiates, how we refer to them, they spend 3 years with us, and they also come from very different countries. We have people from China, Brazil, Mexico, Israel, wherever. So we try to get the most gifted people for these programs as well. And then we have also short courses. So in January we offer a 1-week course on tax treaties this January. In July we offer another 3 days course also on tax treaties, an advanced course. So if you want to have information, it's on our website. So this is maybe something, if you or your colleagues or your people working for you are interested in coming to Vienna for a week, we try to provide basic knowledge in international tax law, in tax treaty law. And then we have all kind of conferences, as I've mentioned also before. We have a lot of foreign researchers, pre-docs or post-docs. So at any point in time, we approximately have 10 foreign researchers who are either professors who are on their sabbatical or postdoc students who also spend time with us, and that makes us really international. So the working language at our institute has become English in the meantime, and but most important have always been the International Tax LLM program, which is there already for 15 years. And in the meantime we have 600 graduates all over the world from these programs. So I'm also happy whenever I'm in India. My former students are kind enough to invite me, so tomorrow evening or the day after tomorrow we'll have dinner together, an alumni dinner, which is also very nice for me to see so many friends and make friends with them here while they are in Vienna. Okay, I hope I haven't taken too much of the time. Thank you for giving the opportunity, and thank you for having us. And I wish you all a wonderful afternoon. Enjoy the talk Professor Van Raad is delivering. I'm really sorry I have to leave, but I hope to see you in Vienna or here in Mumbai again. Thank you very much.
Thank you, Professor Lang. As I mentioned, Professor Kees Van Raad is also a professor of international tax law. In fact, he has been the founder of the International Tax Center at the University of Leiden in the Netherlands, and he's the director of the Advanced LLM course in International Tax Law. In fact, if you look at his biodata, it's an amazing biodata. He's a visiting professor at the Peking University in Beijing, where he teaches an annual summer course on international tax law. He's been, of course, with the Dutch Finance Ministry earlier. He's a visiting faculty at various universities in the US, in London, all over the world. And I'm sure, I think, so we can really look forward to a very interesting subject. I think the subject which he has decided upon, and I think is a very interesting subject. What happens is today with the digital economy, as Nathan referred to, we have the challenges of the concept of PE, the attribution of profits to PE, and therefore he's going to speak on what is the future of active source taxation, of active business source taxation in the source country, the taxation. I think we can look forward to a very interesting lecture, and I would request Professor Van Raad also to speak for a few minutes about the International Tax Center at Leiden University.
Thank you so much. Thank you so much for your kind introduction. I am very pleased to be invited here. I'm very pleased to see so many people in the audience. I think it's a great fifth visit I'm making to India. I was here for the first time in '97 when the first IFA Congress was held in Delhi, and been back during later visits here in Mumbai for the annual conference of Royal Hockey and for other events. And I also want to congratulate you with the, I think, overwhelming success with the IFA Congress this year. I think everybody is very impressed with the organization, with the food, with the academic topics, and with the enormous large turnout of delegates. I really want to congratulate you with this impressive result. Very briefly, during the break I discussed with my colleague a little issue that is important regarding his topic, and that's elimination of benefits provision and the primary purpose test that is going to be included in the OECD model. There was something strange going on. Remember, elimination of benefits provides for technical tests that you can meet. You can call them safe harbor tests. And in the end, there is a discretionary relief possible if you can prove that your primary purpose is okay. So if you flip it around, you can say that the elimination of benefits test is a primary purpose test with safe harbors. You don't have to prove that your primary purpose is okay when you meet the technical safe harbor test. Well, that's the way elimination of benefits works. If you combine that in a compulsory way with a separate GAR in the form of a primary purpose test, so you have to meet both elimination of benefits and the primary purpose test. The elimination of benefits test doesn't work anymore because you have to prove that your primary purpose is okay. And the whole point of elimination of benefits test is primary purpose as discretionary relief or safe harbors. The safe harbors are lost if you combine elimination of benefits with primary purpose. And we do not know whether the combination as proposed now by the OECD, that they simply overlooked the way you cannot combine the two and preserving the true nature of elimination of benefits, or whether it was a little trick that they played, and that we only will later find out that they can't benefit anymore from the elimination of benefits test, because if you have to meet at the same time again the primary purpose test, the safe harbors won't work. Okay. A question I would have asked, but since there was no discussion, I thought I may want to bring this point up. Another preliminary remark, and that's, you see that this is, whole thing is on the heading of a law firm. In Holland, it's quite ordinary that people do what I do. My primary function is a professor. In addition, I work as of counsel to this law firm. They are paying for my trip, so I promised that I keep my things on their sort of the format. And further, in addition, I'm a part-time tax court judge. And that may strike you as quite unusual that you combine those three things. Although you may know that in London, in the tribunal, many of the people serving there are at the same time barristers. So the combination of being at the same time a practitioner and a judge is not unheard of. But in Holland it's quite ordinary that in tax court, and every court, first instance, appeal court, Supreme Court, all courts have special tax chambers of our Supreme Court. And in those tax chambers, not in the Supreme Court, in the Court of Appeals where I serve, in the primary court, they have in addition to full-time tax judges, they also have part-timers like me for special cases. So when tax treaty case will come to court, they typically will call on a part-timer like me to sit, with the full-time judges and participate in the deliberations and the decision making. So that's sort of the background of being a tax professor in Holland, at the same time a bit of a practitioner, and at the same time a bit of a court judge. Well, let's take a look again at the heading of my presentation: future source country taxation of active business income. The term that comes to mind when we discuss source country taxation of active business income is, of course, permanent establishment. As you may know, the term, the concept, the notion permanent establishment came up more than 150 years ago in Germany. Germany was not a single state. There were separate states that concluded treaties. And in one of the earliest treaties in the late 1800s, the term permanent establishment was already used. And what does it mean, a permanent establishment? As you know, it has no ordinary meaning. It's a strict tax term with a very particular tax meaning. And the meaning cannot even be deduced from the words permanent establishment. Because as Jacques Sasseville of the OECD often says, a permanent establishment doesn't need to be permanent, neither needs it to be established. It's simply a word. And in treaties, the two countries can give any meaning they want to these two words in order to define the level of activity and the nature of the activity that they consider to be sufficient to give the source country the right to tax. So, of course, the OECD in its model, in its Article 5, has a particular definition where three types of PEs are distinguished. That's what we call the physical PE, the project PE, and the agency PE. But in actual treaties, you find many, many more types of PE. There's, for example, a heavy equipment type of PE. There is a natural resource exploitation and exploration type of PE. There are various types which countries may agree upon, so we should understand PE doesn't mean a thing by itself, it simply means what the treaty negotiators agree upon to include in the treaty. What are the functions of PE? Well, in the first place, it indicates under which particular circumstances a particular country, a source country, has the right to tax the business income earned by a non-resident person, a non-resident individual, or a company. And it also indicates if that non-resident person is carrying on business in that country, at what level of activity that person is going to be taxed. It's quite surprising that, particularly in the liberal professions, like we have accountants, lawyers, the amount of activity, the amount of income you can derive from a practice in the other country without meeting the permanent establishment threshold. As we know, in practice, permanent establishment means that you're going to be in the other country in a particular way for a period of at least 6 months. When lawyers, what you see a lot in Western Europe, of course, lawyers having clients all over Western Europe fly in and out, do a lot of business through the internet, of course. They can bill enormous amounts of charges, legal charges, accounting charges, without being exposed in the other country to taxation because there is no permanent establishment. So it's a particular notion that was developed over the years, and of which is quite clear that already in the pre-digital era, a lot of activities were simply not ordinarily covered. A lawyer and accountant is going to be subject to tax for professional fees earned only when he really sets up shop in the other country. In the absence of such a shop, there is not much of risk to be exposed to taxation in such a country. So why did they develop, why did they decide over 100 years ago to pick something that we call a permanent establishment to be the threshold for taxation? And that's at the same time indicating what the problem is that we are having today with the whole digitalization of our economic life. Well, a permanent establishment was just pretty much this sort of permanent establishment which is defined in Article 5, paragraph 1, was a physical place of business, an office through which you carried on your local activities. And why did they decide that is a suitable threshold to be met before you become taxable? Well, if you did not have a fixed place of business, how are you going to audit a foreign firm with respect to the activities and transactions and what you're engaged in the other country? So a fixed place of business makes it clear that it's going to be local bookkeeping. A fixed place of business makes it clear that there's a way of collecting your tax. If something is of a taxing nature, you won't be able to audit, you won't be able to collect. Also, a fixed place of business is much more suitable than things of a passing nature to be compared to an ordinary local operation by a local resident entrepreneur. What you need in order to determine the income that's going to be attributable. And that's exactly also the problem that Western countries have with new types of PEs like service PE and project PEs, because it's very difficult often to make a good comparison to an independent local business undertaking doing exactly what this type of PEs do. So, put it in short, a PE has been chosen in that original form of an ordinary fixed place of business because that was the way that local businesses run by local entrepreneurs were being carried on. So, recognizability, auditing, collecting tax, and being able to determine how much income is attributable. Income, I mean revenue and expenses, because APE is going to be taxed on its net amount of income, of course. India is one of the countries that has signed a lot of treaties in which the notion PE is used as threshold for India to tax and as threshold for India to provide limitation relief if Indian companies operate in foreign countries. Many Western European countries have in their domestic tax law also the notion of PE. Countries like many countries in Latin America that so far did not include any tax treaties and have slowly started to negotiate treaties, some of them have felt compelled to include in their domestic tax law something new, the notion PE. Countries believe that if you're going to have a treaty that's going to give you the right to tax when the foreign company has a PE, you better make sure that your domestic law has an enabling rule that makes it possible to tax such income. Surprisingly, that is a huge mistake. Different from what these countries think, Western European countries that have, like Holland and Germany and Belgium and France and Scandinavian countries, all of them have historically in their domestic laws the notion PE. Why is it a problem to have your domestic law, the notion PE, and that same notion in your treaties? If you want to tax a non-resident, you need an enabling provision in your domestic tax law. If a treaty is applicable, that treaty should not restrict you. So at first sight, it seems to make a lot of sense that if you want to tax a foreigner doing business in your country, and the treaty says you can only tax that foreigner if that person has a PE, you can only tax income attributable to that PE, that you have a PE notion in your domestic tax law that says you're going to be taxable on your PE. So what's wrong in that line of thought? Well, the problem is you don't have a single treaty, you have a lot of treaties. And I don't know how many India has, a great many. The United Kingdom has the largest number, 120. Holland has just over 100. Of course, in all these treaties, the PE definition is never fully the same. So there's always going to be some room between what the treaty says and what you can do domestically. So the problem is, since the two terms are the same, people very easily make the mistake that when you see the term in the treaty, you see the term in your domestic law, to simply assume when the treaty says you may tax, that you go ahead and you do tax. You cannot necessarily, because again, you can tax when the facts give rise to a PE domestic law, and the treaty, under that definition, that can be maybe exactly the same as your domestic law, maybe a little wider, maybe a little narrower. The treaty has to look at the thing in the same way as your domestic law does and not stop you from taxing. So if you have the two terms, every time a foreigner is operating in your country, you have to make two very careful determinations. Does the activity meet the PE test under my domestic law? And if so, how is the treaty definition? If it's narrower, then the chance exists that what is a PE domestically is not a PE under the treaty, and you cannot tax. If it's wider, there won't be any problem. If a country therefore will be smart, you would put in your domestic law a criterion which is so wide that whatever the treaty will say in respect of the definition of PE, you're always going to be able to make use of the room given to you under the treaty PE definition. So again, be very careful if you deal with other countries, like Western European countries and now also Latin American countries, that have both in their domestic tax law and in their treaties the same criterion. The name is the same, the meaning of that term is rarely fully identical. It may be true in 3 out of 4 cases, but that 4th case is something that requires your special attention. So, because the time is limited, I'm going to move a little quickly and spend a minute on what's the reason that taxpayers may want to avoid having a PE in the source country. One would think perhaps that if you're going to be taxed in the source country, you're entitled to an exemption or to a foreign tax credit in the residence country. What's the problem? Well, a major problem, as we all know, of course, is the hassle of filing a return in the country where you're operating, filing tax counsel there, maintaining special tax books that meet the requirements for taxation in the source country, and then trying to obtain in your residence country relief based on the same amount for which you were taxable in the source country. Often that doesn't fully work, often it doesn't work at all. You may have to resort to a mutual agreement procedure to obtain your rights under the treaty. A lot of hassle, a lot of expense, something that people of course would like to avoid. Sometimes trying to avoid AP in the source country may also be quite beneficial financially for the taxpayer, namely when the residence country is an exemption country and the source country, for whatever reason, doesn't tax. It happens more often than you may think that a source country may not be aware of the taxpayer having a PE, particularly when you don't work through a physical PE, but when you have, for example, what we call an agency PE. May not be known that a person is going around in your country including contracts. If your home country is an exemption country, you will be entitled to relief without having to show that you pay tax in the other country. The fact that the other country has a taxing right is sufficient to be shown to that country. Or it may happen that the source country simply cannot tax. And again, that does not deprive the taxpayer of the right to claim exemption in the residence country. Not everyone is very happy with that. As a matter of fact, next week I'll be speaking in Washington at a conference of the International Association of Tax Judges. Also, tax judges have their little club, and they do meet once a year, and these are the things that interest them. Should we, as judges, do something through interpretation about those cases of double taxation? As Michael Lang explained, judges have their own mind. Judges cannot be controlled by ministers of finance. They read the treaty and they think of ways that should be applied in order to reach, in their view, the best result. And the best result may be to avoid that double taxation may be applied. But of course, they've got to maneuver within the borderlines of the tax treaty and the rules thereof. In the absence of a permanent establishment, something else can be quite important. If you engage in business activities in the other country and you don't have a PE, and your activities are not very successful and produce a loss, in the absence of a PE, that loss will be part of your ordinarily worldwide income. It will be taken into account. It will offset domestic profits without being considered a foreign loss that has to be recaptured later. So sometimes it may be helpful, particularly in startup phases, to avoid having a PE simply to be able to use that loss without any restrictions. In practice, that's also something that Michael Lang explained, in practice PEs are avoided through Article 5.4. But Article 5.4 is being under scrutiny now by the OECD. They want to change this, as we learned. Article 5.4 deals with cases where there is a PE, but where it's believed that the activities are of a too marginal nature to really use that activity to attribute income to. But with the whole change in nature of doing business, things like advertising, and today advertising through a website, advertising was considered to be a marginal activity. Having a website displaying your products cannot be considered marginal anymore. So many things which are included in that list of exceptions simply have sort of changed their status, changed their nature through technological developments. That's the reason why OECD is thinking of either minimizing or doing away altogether with these exceptions for Article 5.4. Another way of avoiding a PE is working through an agent in another country in such a way that the agent doesn't qualify as a dependent agent under the definition of Article 5.5 and 5.6. And over the past few years we had some very important cases decided in France, in Norway and in Spain dealing with commissionaire arrangements. Arrangements where lawyers very cleverly crafted the legal boundaries in which the commissionaire was operating to carefully avoid that he would trigger the existence of a agency in the other country, and this was recognized by the courts. So agency PE is simply not anymore what it was designed for the first time by the OECD.